Following the peak of 2022, the subsequent years represented a normalization phase of income generation for TotalEnergies. In 2023, adjusted net income moderated to $23.2 billion as Brent prices eased to an average of $82.2 per barrel. By 2024, the softening environment became more pronounced, with adjusted net income reaching $18.3 billion. The primary driver for this reduction was a sharp contraction in European refining margins, which plummeted by 44% compared to the exceptional levels seen in the preceding 2 years. Despite this, the company's return on average capital employed remained at the top of the peer group at 14.8% for 2024, confirming the underlying quality of its diversified asset portfolio.
The conceptual framework of adjusted net income is vital for understanding TotalEnergies' true operational performance. This non-GAAP measure excludes the inventory valuation effect, which fluctuates with oil prices, the effect of changes in fair value, and special items such as impairments. This indicator provides a clearer view of underlying operational trends by stripping away non-cash accounting noise, particularly during years of high asset write-downs like 2022. 2023, adjusted net income moderated to $23.2 billion. Adjusted EBITDA was $50 billion, and IFRS net income stood at $21.4 billion. The refining margin was $70.2 per ton, and ROAC was 19%. 2024, adjusted net income was $18.3 billion. Adjusted EBITDA was $43.1 billion, and IFRS net income was $15.8 billion. The refining margin fell to $39.5 per ton, while ROAC remained strong at 14.8%. First 9 months of 2025, TotalEnergies reported an adjusted net income of $11.8 billion, adjusted EBITDA of $30.5 billion, and IFRS net income of $10.2 billion. The E&P segment remains the dominant profit engine, generating $17.5 billion in adjusted net operating income during the exceptional 2022 environment and $10.9 billion in 2023. The company's focus on low-cost oil, evidenced by production costs below $5 per barrel, ensures that the upstream business remains highly profitable even at $60 per barrel. Meanwhile, the integrated power segment is scaling rapidly. From a proportional adjusted EBITDA of $1.4 billion in 2021, the segment has grown to generate $2.6 billion in cash flow by 2024, with a target ROAC of 12% by 2030. The company's financial health has evolved from a state of post-pandemic recovery to stability. Total assets have generally ranged between $280 billion and $300 billion, ending 2024 at approximately $285 billion. Shareholders' equity has remained robust, finishing 2024 at $117.9 billion, reflecting the accumulation of retained earnings despite significant capital distributions. A central metric used by management to assess financial stability is the gearing ratio, defined as the ratio of net debt to total capital. In 2020, gearing peaked at 21.7% as the company took on debt to maintain its dividend amidst a total collapse in cash flow. The subsequent years of record profitability in 2021 and 2022 allowed for aggressive deleveraging. By the end of 2022, gearing was slashed to 7%, and it reached a historic low of 5% at the end of 2023. 2023. Assets were $283.7 billion, and equity recovered to $119.5 billion. Net debt hit a low of $6.3 billion, resulting in a gearing ratio of only 5%. 2024. Total assets finished at $285.5 billion, with equity at $120.3 billion. Net debt increased slightly to $10 billion due to acquisitions, and gearing rose to 8.3%. Third quarter of 2025, total assets stood at $292 billion and equity at $117.7 billion. Net debt rose to $24.6 billion, bringing the gearing ratio to 17.3%. This recent upward trend in gearing since the 2023 lows is indicative of the company's active M&A strategy. During 2024 and 2025, TotalEnergies executed several large-scale acquisitions, including the purchase of upstream gas assets from Sapura OMV in Malaysia and renewable developer VSB in Germany. The company's asset structure is heavily weighted toward non-current assets, which totaled $188.9 billion at the end of 2024, including $109 billion in property, plant, and equipment net, and $34.2 billion in intangible assets. This reflects the capital-intensive nature of the energy sector, where long-term investments in deep-water offshore rigs, LNG liquefaction trains, and solar farms form the core of the value proposition. The company held approximately $25.8 billion in cash and cash equivalents at the end of 2024, supported by current assets of $96.6 billion that comfortably exceed short-term liabilities. The interest coverage ratio of 15.9x as of late 2025 suggests that the company's financial obligations are well covered by its EBIT. This allows TotalEnergies to borrow at highly competitive rates, providing a cost of capital advantage over smaller peers and traditional utilities as it scales its electricity business. Furthermore, the company's net debt-to-equity ratio of approximately 30.3% is considered satisfactory by industry standards, maintaining a buffer against future commodity price downturns.
TotalEnergies' free cash flow, defined as CFFO minus net investments, has been the primary driver of shareholder returns. 2022, a record CFFO of $45.7 billion and net investments of $16.3 billion produced an all-time high FCF of $32.2 billion, with an FCF yield of 23.9%. 2023, CFFO moderated to $35.9 billion, while net investments were $16.8 billion, resulting in FCF of $26.7 billion and a yield of 8.4%. 2024, from a CFFO of $29.9 billion and net investments of $17.8 billion, the company generated $16.7 billion in FCF, with an FCF yield of 15.6%. The company's FCF yield averaged 12.4% over the 2020-2024 period, significantly outperforming many of its peers in the energy sector. Looking ahead, TotalEnergies expects its free cash flow to grow by approximately $10 billion by 2030 compared to 2024, assuming a consistent environment of $70 per barrel. This growth is expected to come from highly profitable LNG expansions and the integrated power segment, which is forecast to become net cash flow positive by 2028. To understand the durability of the cash flow trends, one must examine the operational strategies and project pipelines within each business segment. The E&P segment is the primary engine for the company's capital recycling. TotalEnergies has focused its portfolio on low-cost, low-emission projects, with a particular emphasis on offshore deep-water assets in Brazil and the U.S. Gulf of Mexico. The company's upstream production costs averaged below $5 per BOE in 2024, which is among the lowest in the industry. Key project startups in 2024, such as Mero 2 and Mero 3 in Brazil and Anchor in the United States, are expected to support production growth of more than 3% in 2025. LNG has transitioned from a supporting role to a core strategic pillar. TotalEnergies is the world's third-largest LNG player, with a market position that allows it to capture significant value from arbitrage and scale. The segment generated $4.9 billion in CFFO in 2024, driven by high availability of liquefaction plants and strong demand in Europe following the reduction of Russian pipeline gas. The integrated power segment is where TotalEnergies differentiates itself from traditional oil and gas companies. The company is building a portfolio of renewable, solar, wind, and flexible assets, gas-fired CCGT, storage, with a target of exceeding 100 terawatt-hours by 2030. The segment's CFFO is expected to grow from $2.6 billion in 2024 to more than $4 billion in 2028.
As of January 2026, TotalEnergies continues to trade at a valuation multiple discount. The valuation of TotalEnergies reflects a market phenomenon known as the European discount. Current market data from early 2026 shows the following comparative metrics: TotalEnergies' forward PE ratio of 9.12x, a dividend yield of 6.04%, a debt-to-equity ratio of 0.54, and a price-to-sales ratio of 0.81. Chevron, forward PE of 22.83x, dividend yield of 4.11%, debt-to-equity of 0.22, and price-to-sales of 1.58. ExxonMobil, forward PE of 18.58x, dividend yield of 3.17%, debt-to-equity of 0.16, and price-to-sales of 1.72. Shell, forward PE of 11.42x, dividend yield of 3.86%, debt-to-equity of 0.45, and price-to-sales of 0.82. TotalEnergies offers a higher dividend yield of 6.04%, which is the highest among the primary supermajors. This yield is well covered by earnings, with a payout ratio targeting over 40% of CFFO. The European discount is largely attributed to institutional perceptions of ESG risk and the perceived complexity of the energy transition compared to the more traditional strategies of U.S. peers.
To combat this valuation disparity, TotalEnergies has initiated a process to transform its American Depositary Receipts, ADRs, into ordinary shares to be listed directly on the New York Stock Exchange, NYSE, effective December 8, 2025. This move is intended to improve the company's visibility among U.S. institutional investors. Based on current financial data and projections as of January 2026, a discounted cash flow (DCF) valuation of TotalEnergies suggests that the stock is undervalued by the market. The following analysis utilizes a two-stage DCF model, which accounts for a 10-year period of growth followed by a terminal value representing the company's steady state in perpetuity. DCF valuation assumptions. To arrive at an intrinsic value, the model relies on several key inputs derived from management guidance and consensus analyst estimates.
Discount rate, WACC, estimated at approximately 7.2% to 7.5%. This reflects a cost of equity around 7.76% based on a beta of 0.86 and a cost of debt of approximately 4.78%. Terminal growth rate, set at 1.4% to 1.5%. This is a conservative estimate aligned with long-term global GDP growth and energy sector inflation. Cash flow baseline, based on the latest 12-month free cash flow of approximately $14.1 billion to $15.2 billion. Growth projections. Management anticipates growing its free cash flow by approximately $10 billion by 2030 compared to 2024, assuming a constant $70 per barrel Brent environment. Analysts expect more moderate near-term growth of 2 to 3% in revenue and earnings during the transition period.
Estimated intrinsic value calculation. When discounting the projected cash flows back to their present value, the model yields the following results. Present value of 10-year cash flows, approximately $60.4 billion to $106 billion, depending on the transition growth in the integrated power segment. Present value of terminal value, approximately $138 billion to $173 billion. Total equity value, estimated at $244 billion to $251 billion. Dividing this total equity value by the approximately 2.2 billion shares outstanding results in an estimated intrinsic value per share. Intrinsic value per share in euros, approximately 102 euros. As of mid-January 2026, the stock trades around 57 euros on the Euronext Paris exchange.
Risk assessment. The company's global footprint exposes it to significant security concerns that can delay production or lead to asset impairment. Russia sanctions and stranded assets. TotalEnergies remains exposed to evolving European and UK sanctions. A comprehensive ban on importing Russian liquefied natural gas, LNG, is set to take effect on April 25, 2026 for short-term contracts and by January 1, 2027 for long-term contracts. This directly impacts the company's involvement in Yamal LNG. Furthermore, the company has approximately $1.5 to $2 billion in dividends held in Russian accounts that it currently cannot withdraw due to sanctions and counter-sanctions. Mozambique security.
While the force majeure on the $20 billion Mozambique LNG project was recently lifted in October 2025, the project remains vulnerable to Islamic State-linked insurgent activity. Delays have already pushed first exports back to 2029, and any recurrence of violence could further threaten this critical revenue source. Nigerian onshore divestment. TotalEnergies has signed agreements to divest its 10% non-operated stake in various onshore and shallow water licenses in Nigeria to mitigate operational risks, community disruptions, and environmental liabilities. However, these divestments remain subject to regulatory approvals, and the collapse of previous deals, such as the 2024 Chapal Agreement, highlights the difficulty of exiting these high-risk areas.
The East African crude oil pipeline has become a focal point for global activism. Over 40 commercial banks and 30 insurance firms have refused to finance the project directly due to environmental and social concerns. This has forced TotalEnergies and its partners to self-finance nearly 90% of the project's $5.6 billion price tag, significantly increasing their direct financial liability. Power market returns. TotalEnergies aims for an ROAC of 12% for its integrated power segment by 2030, a level comparable to its upstream oil returns. Achieving this will require competing against established utilities and managing the inherent intermittency of renewable assets. Analysts have noted that the 2024 ROAC for this segment was lower, at approximately 10%. Oil price fluctuations. The company's earnings remain highly sensitive to Brent crude prices. For 2026, the board has approved share buyback guidance based on Brent prices staying between $60 and $70 per barrel. A drop below this range would likely compress shareholder payouts. Windfall and solidarity taxes. Several European countries, including the UK, Spain, and Lithuania, have extended or implemented permanent windfall taxes on energy profits. The UK's effective tax rate for oil and gas companies operating on its continental shelf stands at 78% until at least March 2029.
The bear case for TotalEnergies. Commodity price volatility. Earnings remain sensitive to prices. A sharp global recession depressing Brent below $60 would impact buybacks and power segment growth. Refining margin normalization. A structural downturn in refining could drag on overall CFFO, especially if the power segment takes longer to become net cash flow positive. Execution risk in power markets. Scaling to 100+ terawatts requires flawless execution. Competition with established utilities and renewable intermittency could pressure the 12% ROAC target. The bull case for TotalEnergies. Unrivaled LNG exposure. As the world's third-largest LNG player, TTE gains as natural gas is viewed as an essential bridge fuel for decarbonization. Capital discipline and shareholder payout. The commitment to a 40-50% payout ratio provides a high floor for returns. Even at $70 oil, the company projects $10 billion in additional free cash flow by 2030. NYSE re-rating. The primary U.S. listing for ordinary shares could be the catalyst that closes the valuation gap with U.S. supermajors.